Thank you for joining us at XM.com. I'm Christina Marujos, and you're watching today's Daily Market Comment by Mario Hadjikyriacos. The stakes are sky high going into this U.S. employment report. Fed officials have made it crystal clear that the most important element for the normalization of monetary policy is the labor market. Hence, the upcoming data could determine whether a September taper announcement is realistic or premature. Nonfarm payrolls are forecast to clock in at 870,000 in July, pushing the unemployment rate down 2 clicks to 5.7%. That said, there is tremendous uncertainty around these forecasts. The market reaction will likely depend on the magnitude of any surprise. Anything above 1.3 million for non-farm payrolls could fuel bets for an earlier withdrawal of Fed stimulus, turbocharging the dollar but hitting stocks. On the flip side, a figure below 500,000 might sink the dollar and lift equities. Something in between is unlikely to rattle markets much. Bear in mind that the S&P 500 has closed higher after every single employment report this year. Bad news for the economy is good news for stocks, as investors price in more Fed liquidity for longer, while good jobs news is great for corporate bottom lines. For equities to bleed, it would probably take an incredible job report that sparks panic about the Fed tapering immediately. The Bank of England kept policy unchanged yesterday. However, the overall rhetoric was quite hawkish, so the pound soon recovered to trade higher overall. The bank signaled that some monetary tightening will likely be needed if the economy continues to recover well. But the most crucial part was around asset purchases. Once the bank rate hits 0.5%, the bank will stop reinvesting bonds on its balance sheet that mature, essentially draining liquidity out of the sterling market. This means that after 2 rate increases, the Bank of England will begin quantitative tightening, which is great news for the pound in the long term. The party on Wall Street continues to rage, with both the S&P 500 and the Nasdaq closing at new record highs yesterday. The earnings season has been spectacular so far, reflecting the strength of the recovery. Meanwhile, gold took a hit yesterday and remains under pressure early on Friday, suffering at the hands of a firmer U.S. dollar and a recovery in real Treasury yields. A break either below $17.90 or above $18.35 is needed for bullion to escape its trading range. This was today's Daily Market Comment. Thank you for watching at XM.com.